Welcome to Public Policy Show. We're live from Harvard Business School. My name is Shota, and today we're going to be sharing Children for America's findings with the Federal Reserve. Children for America is a think tank here at Harvard, and we found two fascinating discoveries. And since the Federal Reserve is having Fed Listens campaigns on September 4th and September 26th, we decided to share with them our findings on the US monetary policy. Today's show is addressed to Jerome Powell, who is the chairman of the Federal Reserve, to Michelle Bauman, who is in charge of banking supervision, to James Bullard, who is the president of St. Louis Federal Reserve, and Mary Daly, who is the president of San Francisco Federal Reserve. First, let's look at Federal Reserve's goals. Since the late 1970s, the Federal Reserve was given two main goals by the US Congress. One is maximum employment, and the second one is stable prices. If we look at the US economy from the 1980s to today, we know that GDP has increased substantially, but we also know that income inequality has been increased at the same time. The findings at Children for America indicate that 10% increase in GDP over the last 40 years decreased real incomes by 11.5%. And this is substantial. Here we're talking about real incomes of working and middle-class Americans, which comprise over 90% of US population. Now let's look at second part of Federal Reserve's responsibility, which is stable prices. We know that firm entry usually indicates that markets are competitive. Our findings at Children for America indicate that since 1948, firm entry by 100,000 firms in the economy has been positively related with real incomes. So 100,000 firms in the economy are associated with 17% increase in real incomes, and this is substantial. If that trend were to continue from 1978 to present, then each household in the United States would have over $300,000 in their savings. The gap on average has been around $8,000 a year because of the fact that antitrust policies, and specifically bank mergers that allowed banking consolidations starting in the 1980s, contracted entrance of small businesses in the markets. So that caused decrease in firm entry, increase in market consolidations, and as a result, real incomes have been stagnant over the last 40 years. So Fed is in a conundrum right now. They want usually around 2% inflation because little inflation allows for new firms to enter the market and new small businesses increase real incomes. Why? Because the more firms there are in the economy, the more competition for labor, and thus the higher the wages. So our suggestion to the Federal Reserve is the following. The Federal Reserve has the authority to limit bank mergers and also to limit interstate banking. We strongly suggest the Federal Reserve to leverage this power and to start enforcing antitrust capabilities within the Federal Reserve System so that smaller banks are able to succeed. And we know that banking consolidation over the last 35 to 40 years has caused substantial decrease in small business lending. And small business lending is critical because when banks, usually commercial banks, take deposits, they loan out funds to small businesses, and this way they're able to increase the supply of money in the US economy. When large banks are allowed to go into smaller markets, then they take deposits and they use the funds for trading, and trading does not increase the supply of money in the US economy. This is why we are strongly suggesting again for the Federal Reserve to start enforcing its power to limit bank mergers and interstate banking. We know that firm entry in the economy, again, increases competition for labor. And increased competition for labor, if we look at recent history, back in 1955, when the Federal Reserve was actually promoting small business banks and community banks, number of firms in the economy was over 128,000 in 1955. By 1968, number of net new firms that year alone, which is 1968, was over 220,000. But decrease in number of small banks and number of firms as a result generated an economy where we have less than 13,000 firms by 2014 formed in this modern economy, regardless of the fact that the population grew over 80 million since the 1980s. Again, we are encouraging the Federal Reserve to increase its enforcement of bank mergers, both vertical and horizontal, and interstate banking, which was limited and actually forbidden prior to 1994, needs to be limited again so that large banks are unable to go into smaller communities and destroy small businesses in the process. Thank you for watching today. We'll be live here at Harvard Business School next week at 9 p.m. Have a good night.